Good afternoon, everyone. This is Peter Stanton, publisher of the Worcester Business Journal, and I'm your host for today's session on financial strategy during COVID-19. Today's conversation we're titling Cash is King, Managing Your Resources During This Crisis. This program is, and if you've been paying attention to the emails and what we've been doing at the Worcester Business Journal, is part of an ongoing COVID-19 webcast series on managing through a time of crisis. And it's made possible through the support of our presenting sponsors, and those are, you can see them on your screen right now, Fallon Health and Webster 5, two organizations who are together supporting a number of webcasts aimed to help Central Mass business owners and executives successfully navigate their way through this current economic and health crisis. It's been a wild ride, as most business owners would recognize, since the state implemented its first wave of shutdowns, and I think that was back in early to mid-March. While some industries have barely been affected by the shutdown, many have taken a real revenue hit. Thankfully, many businesses, and I think the reports indicated that pretty good penetration in our region were able to receive PPP loans, whereby the bulk, if not all of those proceeds, hopefully will be forgivable in the coming months. Firms that opted for that 24-week period obviously will, that wraps up probably in September and October. And yet looking ahead, our economy has not really yet recovered, and managing through the next few business quarters looks to be a real test for many businesses, especially small business owners. So whether we're in a pandemic or not, the phrase is king has always rung true. Especially during difficult times like these, the right strategy and a real command of cash flow and expenses will be needed to navigate your company through this difficult time. We've got a great panel of experts, including a banker, an accountant, an attorney, and a business consultant who will share their wisdom and best practices. This pandemic presents significant challenges, and focusing on your financial resources will give you the best chance to build a cushion and gain the flexibility that will allow you to weather these turbulent times. Our four panelists for today's session bring a varied background and perspective to the conversation. So I'm going to introduce each one of them individually, and then after those introductions, I'll ask each one to give an overview of what they're seeing from their perch, how they're working with clients to help them manage through the pandemic. So let's welcome them. First, Chris Watson, Senior Vice President and Senior Lending Officer of the Business Banking Division at Webster 5. Nice to have you with us, Chris.
Good to be here.
Leo Correa, who's the CFO and a partner at the Delta Group, LLC. Leo, nice to have you with us.
Thanks for having me here.
And Jessica Murphy, who is of counsel at Myrick O'Connell. Jessica.
Thank you, Peter.
Good afternoon. And Janice O'Reilly, who's a CPA and CGMA and a partner at AAF CPAs.
Good afternoon, everyone.
So we're gonna start off with some just sort of a kind of an introduction, and like I said, here where each one of these professionals is kind of coming from, and I'd like to start with a few comments from Chris Watson. Chris.
Good afternoon, everyone. I hope everybody is faring well, dealing with the heat, and also this pandemic, trying to get through all these last few months, and looking ahead at who knows what lies ahead. So I appreciate being asked to be part of this panel. Peter and I have dealt in the past early on in the series, specifically when the PPP was first rolled out. So now I'm here to kind of discuss other strategies that the bank is working with the customers. There's 3 or 4 different areas that we're dealing with customers. Of course, the first being the PPP that Peter mentioned. I would say at this point, most, if not all, of our business base has received a PPP loan. The program has been extended by the SBA through August 8th. So if you have not received your PPP loan, there's still time. reach out to your local institution and they can work with you on getting this loan, which, as Peter said, if used appropriately, should be 100% forgiven and really help you out with meeting payroll and some operating expenses. One of the other areas that we're working with our customers on to try to help them preserve some cash throughout these trying times is granting them a loan deferral. So we sit down and we discuss with the customers their needs. They have 1, 2, 3, multiple loans with us that obviously require monthly payments of principal plus interest. So the regulators are working with the banks and allowing banks to grant customers 3-month, initially 90-day deferral period with no penalty, no downgrades at the bank. So we've done that, I would say, last calculation, about 25% of our portfolio, our commercial lending portfolio, have asked for a 90-day deferral. Since the initial 90 days, the regulators have then allowed a second 90-day period. And this is pretty important because generally, after 90 days of something like this, the bank has to downgrade the credit. We have to increase our reserves. And we have to code it what we call a troubled debt restructure loan, all requiring a lot more work at the bank, and increasing the reserves makes it a less profitable loan for us. But the regulators are granting a second 90-day period, thereby relieving any penalties to the banks and the customer. So if you have not, that is clearly one way that you can deal with your banker and request that 90 or up to 180-day period, which is essentially 6 months worth of loans. Another way, my fellow bankers might not appreciate this, but with the interest rates being reduced as they have been in the course of this year, as residential rates are, commercial rates are at all-time lows as well. We've had many customers come in and discuss with us about giving them what they consider a more marketable rate based on where the current market is. So if they had a loan traditionally, that was on the books at the bank at 4.5% or 5%, we're now rewriting that at 3.75% or 4%, depending on how long they want to lock the rate in. In some of these loans, if they're fairly sizable, taking a 1% off the books can save them some considerable cash over the life of the loan. Recently, there's been another program that has been gone live by the government. This is called the Main Street Lending Program. It was it just went live about 2 or 3 weeks ago. Initially, it was for the larger borrowers. When they first rolled out the program, the minimal loan amount was going to be $1 million, and they have since reduced it down to $250,000. It is at very favorable rates. They're using LIBOR pricing for that. So it's currently at LIBOR plus 300, and the loans are repayable over 5 or 7 years. What happens is you deal with the bank to obtain this government loan. The bank grants the loan, and then the government will buy 95% of that loan from the bank. So there's little to no risk to the bank. The government will pick up the loan, and you, the borrower, will end up with a loan that is, favorable at, LIBOR plus 300, which today is about, 3.17% over a 5 or 7 and upwards to a 10-year period. So those are some of the strategies we're dealing with our customers. There are some other ones out there. We do have some customers that have initially, they're very debt adverse, as most customers are, and they'll come in and they might have a real estate mortgage with us, and they're paying it back over a 10 or a 15-year schedule. We're looking at that, and if there's plenty of equity, then we're rewriting that over a 20 or 25-year period. Again, that cuts their payments down. Some customers are, doing 1, 2, or 3 of these programs, and it's allowing them to preserve quite a bit of cash over the next 3 to 6 months. So those are some of the strategies we're working with our customers are, and I guess we'll throw it back out there to Peter.
Sounds good, Chris. Thanks. That's a great recap. And next, I'd like to call on Leo and kind of hear what the Delta Group, how you're working with clients and what you're seeing is helping them in this market.
Thank you, and hello, everyone. First of all, from our perspective, we actually look at this whole transition in the economy as in 4 stages. And we look at it as a shutdown stage, a startup stage, a recovery, and then a new normal. And basically, when we look at the shutdown stage, it's pretty much what we've already been through. It's the partial or full layoffs of some people. There are decrease in operations and income streams. And then there's disaster relief that's out there, as Chris described, the PPP program, and some have used the SBA's EIDL program. The startup stage is really interesting because this is where you're trying to get back to business, but things aren't really rolling at 100%. Revenue is not really as active as it should be. Supply chains may be limited or slow in responding. And at this point, this is where you're restoring your employment and actually utilizing some of the PPP funds. The third stage that we look at is really a recovery stage. And this is where revenues and operations get very close to normal. And there's maybe some lost revenues because some markets may have decreased permanently. And it actually gives you the opportunity to identify new products, new services, or just be more digital opportunities. At this stage, in the recovery stage, this is where we look at trying to find some restructured financing, which is, as Chris mentioned, the Main Street lending program is a big one we see that is very promising, as well as any type of conventional lending. And then the final stage is really trying to optimize the business model for a new normal, trying to optimize that profitability. And really, our focus is really to try and build a strong balance sheet. We're of the opinion that a strong balance sheet is essentially like the new gold standard. And it gives you the ability to weather any storm. And along this process, we have a whole host of financial modeling tools that we use to run the different scenarios, to figure out what really is mathematically going to work best and to redefine that business model. And we do that through projections, and these are things that are going to help through the recovery and new normal stage to help redefine the whole business model. And that's our approach.
Terrific. Thanks, Leo. And Jessica, from Myrick O'Connell, what are you seeing with your clients, and what kind of advice and counsel is going on these days from your
Thank
view?
you, Peter. Thank you, Peter. I'm Jessica Murphy. I'm a 15-year commercial litigator with Myrick O'Connell. That means I'm the attorney that you'd see in the courtroom. Nowadays, it means, like this morning, I'm the attorney who's on a telephonic hearing with the court or on a Zoom call like this, with cases being heard and motions being decided. So my clients are generally business owners, landlords. I have a fair number of clients in the construction industry and suppliers. These are people who are calling because they're having difficulty paying their bills. They're wondering how to accelerate their receivables so that they're getting cash in the door. Generally, there had been a slowdown in litigation once the courts closed, and the courts had actually told all the deadlines for cases that were active, as well as statutes of limitation, through June 30th of 2020. Now that we've passed that, there has been a fair bit more activity in a lot of these cases. And I think the courts are very willing to see people move forward. So what had been initially a slowdown in litigation because people were either interested in conserving their own cash or not sure how courts were going to be dealing with cases that were active, they've found that that is now opening back up. I am seeing a lot more things going forward. It's becoming more routine, although certainly the process of having a court hearing in my home office is a little different over Zoom. Firm-wide, we've been dealing with questions about HR issues, how businesses should be operating during this time, bankruptcy issues, even estates and trust planning. So the firm as a whole is taking questions like that. But what I'm really seeing on the commercial side is that things are starting to ramp back up, and people who want to be in court or need to have their disputes resolved, need to try to get somebody to pay. We're largely back in operation on that.
Sounds good. You know, it's interesting when you mentioned how much is going on through Zoom. I was thinking of if telemedicine could work so well, why not telelaw, right?
It is definitely a brave new world. Jury trials are the one thing that they're having difficulty with. But I just had a jury trial scheduled for March of next year this morning. So we'll take it in bits and spurts.
So the question, do I wear the brown suit or the pink suit? That's less critical when you're not in front of the live people.
That is true.
Okay, so next I'd like to introduce Janice O'Reilly, who again is a CPA and a partner at AAF CPAs.
Thank
Janice.
you, Peter. And I think I'll echo what many of my fellow panelists have said in that there's just a lot of questions coming in, some that we are able to address directly and others that are still not really clear. Even through some of the PPP forgiveness calculations, there's still some unclear areas as was discussed. But what we really try to do is take a holistic approach to what's happening at clients. So from my perspective, which is accounting, tax, advisory, even something like the PPP loans can impact someone's financial statements. It can impact their covenants. It could impact their tax return. It can impact cash flow, hiring decisions. So we try to take a very holistic approach as to what decisions clients should be making about PPP loans, about debt restructuring, about how to improve cash flow. Do they hire? Do they fire? Do they take advantage of some of the FICA deferrals? So it's a very complicated world, and what we really stress is to take this holistic approach, because you don't want to make a decision on one side of reporting that's going to have a significant impact on the other. So we really try to look at that as a whole. And our firm has specialists in tax, audit, accounting, advisory, valuation, wealth management, and it really is important to take a look at the situation as a whole. I think the biggest piece that we're looking at now is what life is like for a lot of these companies and organizations after the PPP loan. So the PPP loans help them out through 10 and a half weeks of payroll equivalent, and it really help them through that period. And now they're looking at forgiveness, and hopefully with the extension to 24 weeks, they'll get full forgiveness. But what does life look like now? What are some of my other funding sources? How do I improve my cash flow? And so I think that's really where we're at right now, is helping with forgiveness calculations and just saying what happens now after PPP.
Got it. Well, and of course, we won't delve into all the political considerations related to some renewal of PPP, right, which is clearly, being debated in Washington right now. It's a little hard to have a crystal ball for that, but hopefully there's more relief on the way.
Yeah, we do have a little bit of an extension now through August 8th that just came out of the application date, but there's still some clarity that needs to happen on the forgiveness calculations.
Understood. So there are a number of questions that came in beforehand, and I want to encourage all participants that if you have a question, there's a Q&A box at the bottom of the Zoom cast in that little reverse bar at the bottom. And so if you have a question as you're listening to this conversation, please feel free to fill that in, and I will take a look at those as our conversation goes on and make sure we bring as many of those up as we can. But we have a lot of questions that came in beforehand, and we're going to kind of frame it in a few different categories. And I think the place to start is really where Chris started, which is working with your bank. And Chris had volunteered, that they're this program of initially a 90-day and 180-day delay. I'd like to hear from some others about sort of how you've been advising clients as well. And Chris, if you want to add more anecdotally, that's cool too, but maybe we can start with Jessica, advice you're giving to clients related to their banking relationship.
Well, and the main thing that we're advising people is to make sure to pull out those loan documents and understand what your obligations are. You might be talking with Chris at Webster 5 about getting a deferral, but what exactly does that mean? What are you deferring? Is it the payment? Are you deferring financial reporting obligations? A number of loans are going to require you to provide annual financials. If that has come due between March and now, are you still providing those? Are you still required to? So as with anything, you really want to make sure to pull out, read your loan documents, and understand what your obligations are. When you start talking about modifications, if you're going to approach your bank on that, as Chris had talked about, there's a number of different programs. The banks are very willing in this circumstance to see that there's a regional issues. Obviously, this is global and national. So this is not just one person being affected. They're taking a look at these and they're figuring out what can be done. If you do have an agreement with your bank, I strongly advise that you take the time to make sure that this gets put into writing. It's typical that for a regular loan that gets modified, that's not through a particular program, you're going to see a forbearance and loan modification agreement. Read that, make sure you understand it, make sure it fully encapsulates what it is that you are agreeing to do and defer. If there's a question about whether certain things become due, what the interest rate is going to be if it's deferred, are your payments that are deferred going to be due in a lump, or are they going to be due in staggered payments over time? These are all really important questions, and as you identify what your actual modification will be with a bank, as with any type of creditor, you want to make sure that you get those in writing and that they're understandable. Loan modifications are typically a very short document, and it gives you the opportunity to make sure that it's readable. This shouldn't be in language that you can't understand.
Sounds good. Janice, did you have anything to add from your perspective in working with your bank clients that have bankers?
Yeah, so we sort of tag team at the end of that. So once you do get those modifications, there are some accounting implications, particularly for debt restructuring, that you'd want to take a look at that. You want to make sure that you have any waivers in place that you may need for any covenants. You probably want to pro forma out any of your new covenants when you're talking to your bank about that. And you know, we also encourage you to talk to your bank about any other opportunities for maybe a Main Street lending or other opportunities to look at any other cash flow, working capital, and anything else that might help your cash flow. But I just think it's important to think about the impact on your financial statements, how that impacts your tax, and to make sure that you're being very proactive about talking to your bank about any covenants.
Terrific. And Leo, did you have any best practices there you wanted to?
Sure. Our approach, you know, these are very, as we said, very uncertain times, and everyone's trying to figure everything out as to how all these pieces fit together. And really, to work with your lender, your bank, we believe that to get flexibility from your bank, we like to increase transparency. And, you know, a bank is looking at their loans and their portfolio and trying to judge collectability. And collectability is achieved through profitability and a strong balance sheet. But there's a lot of uncertain times right now. So we find that in times of stress, sharing the financial impact of a plan or your roadmap to create transparency is really the key thing to try to get participation from the bank, because we look for a solid financial model going forward, trying to map out cash flow, and really to do this and create transparency as to how all this is going to work even through the most stressful times, really gives you the ability to go and ask your banker for a participation in this plan where they can, and they have to know that there is some managed risk here, that they can feel comfortable with that. So it's our belief that the transparency is a key thing along these stressful times to really involve your banker a lot in these whole plans, because there are going to be very stressful points along the way.
You know, I've heard it described that sometimes your banker wants to be in the no surprises end of the business, where you're not walking in. And so, Chris, that was a bunch of commentary sort of on working with banks. You get, as the judge and jury here, you get to accept or refute any of that
You know,
or add to it.
in my initial overview, I think I kind of mentioned the deferrals in a simplistic approach, but oftentimes it's not that. And I think every one of the other panelists hit on very important topics that we are considering when we're looking at these deferrals. Obviously, you know, to your point, no surprises. That's something that I tell every one of my customers. You know, I'm a banker, I'm conservative. If it was fashionable, I'd wear belts and suspenders. It's just, we don't want surprises. Communication, to Leo's point, is key. We got to know, you know, when you come to us, say, hey, I want a 3-month deferral. Why? Explain the situation to us. Be transparent. You know, to Janice's point, there's oftentimes, you know, financials are due. There's covenants that we need to be considered. So do we, you know, while we're deferring it, it's going to affect the covenant. So do we rewrite the covenant? Do we put a waiver in place? And we've done that with a couple of them that we just said, you know what, because of the circumstances that beyond your control, we're going to modify this for 6 months, give you a 180-day deferral, and we'll also waive the covenants for, you know, this quarter and this quarter, and we'll address it down the road. And of course, not to leave Jess out, we have 0 of our modifications are done without legal documentation. You know, we're not attorneys here. They're complicated instruments, and so we've used Myrex quite a bit to get some of these done. So you got to make sure, to her point, everybody is on the know and understands what is going on, is on the same page. That's very important. I want to make sure that everybody's on the same page.
That makes sense. So to go to the next question, I'm going to actually float right back to Leo, because one of the questions was additional financing options, and others can jump in on this as well. But we talked about economic development organizations, whether there are additional state resources, SBA. I mentioned the SBA. It's interesting. Webster 5 was the SBA lender of the year last year for some business quarter in which I think you loaned $850,000. You know, followed by 50 million this year in that same quarter, approximately.
Times have changed.
Yeah, they have changed. But other SBA programs, you know, the Mass Growth Capital, Leo, any other thoughts about?
Sure. Well, obviously, we've talked about the SBA, the PPP program, and the SBA also has the EIDL program, which is the Economic Injury Disaster Relief. And what's interesting, the Treasury Secretary Mnuchin was testifying before a congressional committee last week and talking about a new package that they want to bring about. And it would be something similar to the PPP program or some type of grant program. What was interesting is instead of payroll based, they were looking at it to be a lost revenue formula. Now, there really isn't any discussion as to how that would work and when this would go in place. There's a lot of things up in the air, but realize that the Treasury is coming up with these plans, trying to institute these with Congress to try and bring about some additional stimulus to some of these. Now, one of the programs that we've already mentioned is we're pretty excited about is the Main Street Lending Program. And this actually lends into the whole idea and the concept of a recovery stage that we were talking about. Because what the Main Street Lending Program does is it really gives companies breathing room. For example, the first 12 months, usually it's a 5-year loan, and the first 12 months have no payments. So obviously an easing on cash flow. The interest at that point in time is capitalized onto the balance. But the second 12 months are interest only. Again, keeping payments low and easing cash flow. And the third 12 months is really like an 11 in 1. It's 11 months of interest only, and the last payment is a 15% principal payment in that 36th month. So it's really, what it really turns out to be is, although it's a 5-year loan, it really is 3 years of breathing room for these companies to restructure, reorganize, and improve their cash flow along the line. From a banking perspective, as Chris mentioned, the Federal Reserve will buy 95% of the loan and reduce their exposure. But the real key here is that you get your breathing room for approximately 3 years. And in that year 3 through 5, you're really looking at the idea of restructuring that loan and refinancing it and terming it out to whatever is appropriate. It's a very exciting program. We're looking forward to it. There are others. There are things like Mass Growth Capital. We work a lot with Mass Growth Capital, and they can be a subordinated debt, which really kind of helps the bank in their position, and it improves the senior debt leverage ratios. They may have an interest-only period in some of theirs, but the problem is it's a little bit more expensive. It's mezzanine financing, so it is going to be a little bit more costly. So figuring out which one of these plans that are out there, and I'm sure that there are going to be more that are going to come out. But these are an example of there's no one plan that fits all, and you really have to try and figure out which one of these or a combination of these are really going to fit your situation.
Question on the Main Street Lending Program. I know with PPP, there was a rush to the bar, excuse the metaphor, when there was a fear that the funds would run out, right? Does the Main Street Lending Program have a similar cap or timetable to it at this stage?
Yeah, it does, and that's a great question, because right now, the way that they've structured this is they actually have, I believe it's $675 billion allocated to the program, and the program is planned to end on September 30th. But the interesting thing about this whole program is to get it extended, they don't need to go back to Congress. They can actually, the Federal Reserve has the ability to extend the program and modify some of these provisions in the program. So I expect, although the last day and the end date is September 30th, provided that the funds are there, I expect that they will extend that, because again, this is the recovery loan that companies, they are hoping healthy companies will be using that experience problems because of the COVID-19.
Mm-hmm. Interesting. And Janice, do you have a quick take on sort of those first couple of years? That's a real cash flow advantage. How heavy does that look on the back end for someone making that assessment? Have you looked at modeled these yet for?
Yeah, we have. I think one of the key things here is to pro forma out where they think they'll be. There's just so much uncertainty, though, as to when they think that they'll be recovering and getting back to their normal state. But I think what we've been saying, and it goes along with the theme of this presentation, is that cash is king. And even if you are going to have to repay it, the terms are very favorable. And we really encourage people to look at these loan programs. The other thing that I wanted to mention, and it's a much smaller scale, but it can be very helpful for smaller businesses, is that there are a lot of grant programs offered by cities and towns, particularly for things like restaurants who are trying to just spend extra money on all of the added compliance items that they need. I think it was the city of Marlborough or something that one of my clients went to recently. But I would really encourage, I encourage my clients to also check for anything regional or with their city or town. And a lot of the companies I work with are very small, and something like the Main Street Lending Program is way off their radar. So, but they have been able to find some relief even just for some of the smaller compliance issues. I think we concentrate so much on payroll protection, which is what the PPP was all about. But some of the smaller businesses are just struggling with compliance. It's looking at lower volume. It's looking at all the added costs. So in addition to looking at pro formaing out how we think that some of these additional cash flows will help them, we're really trying to tap into any other sources we can, particularly if there are any grants.
Got it. Okay. So next I'd like to shift to, and what we're really doing is kind of going through a lot of the major cost categories, right? So your cost of financing and your banking relationship is critical. And one of the next ones on the list was real estate leases. And so we've heard a number of stories, anecdotal, about, people getting relief or not. What strategies are companies using that you've seen that they're using, and what's working? And Janice, maybe we can start with you on that.
Yeah, this is one where it's been tricky. Some clients have had great success and others have had zero success. So it is something where you'd want to definitely talk to your lawyer or even your landlord. So for example, when you're going through your lease, if you are buying or renting sort of like Class A space, it maybe includes a cafeteria and a gym. And now that those things aren't offered, are you really in that type of space? Is there any negotiation there? I mean, we've seen some landlords being very flexible because their own costs have been reduced, but others who are not. So, there's also the force majeure things. I'll let someone like Jess talk more about any of the legal terms, but we're very much encouraging, since rent is a huge expense for many companies after payroll, that use your PPP loan for your rent. As you know, up to 40% can be used on that. And also be very creative in dealing with your landlord. See if you can get a deferral, see if you can get some sort of rent reduction. I know that many people are not using the lease space as much as they had been. Is there a way to modify the lease agreement? And as I said, I've seen it probably about 50-50. Landlords also have a lot of expenses, so some of them are more willing than others to be able to negotiate, or more able to negotiate than others.
And Jessica, I know you've worked with clients in reviewing documents. What's your advice in this area of negotiating with landlords?
And I've actually seen this on both sides. I represent both landlords and tenants. So I will agree with Janice. It does depend. I don't see it as prevalent as some of the deferrals and modifications the bank are giving out. It's just not as automatic because these landlords have real expenses and the landlords are not getting rent relief mortgage relief necessarily, depending on what type of landlord they are. So the biggest thing you can do is be open and honest, talk about what you need, take a look. What we're seeing for deferrals is that we're largely seeing deferrals, not rent forgiveness. Some people are taking it and tacking it on to the end of the loan, that we're going to defer rent for 3 months this year, we'll tack it on. Those things are obviously complicated by the PPP loans, which actually frees up money to pay your landlord. So what we're encouraging people to do, and frankly, 4 months into this pandemic and the closure of a lot of the physical locations, a lot of people have had these discussions with their landlord. But with the accessibility of PPP money to pay your landlord, what you want to do is think about, can I take that 3 or 4 or 5 month deferral I had been looking for and see if I can tack that on to the end of it? Can I use that next year? And so you're spreading out your obligations, and really make sure that you're talking about whether this is a deferral, whether this is a forgiveness, because those are two very different things. If it's deferred, are you paying any interest on this? And can you spread it out? Sometimes getting a large bill like this sounds like a good idea and does free up cash now, but you do have to be cognizant, can you afford to pay this in a lump sum, 3 months rent next year, when we're not quite sure what the landscape will look like next year? Similar to something Chris had mentioned, with your landlord, it is actually unenforceable to have a modification of your lease unless it is in writing. So if, and to the point, even if you're talking with your banker and someone suggests something and you think you have an agreement, you do need to make sure that you get those things in writing. Documents now can be electronically signed. You can have agreements by email. But again, whatever agreement or modification you're going to come to does need to be in writing. I'm the president of the board for Habitat for Humanity. I've seen that our landlords for our commercial spaces have been willing to take that chunk. They've been willing to say PPP money is coming to us. So I've been seeing in our own experience that these deferrals are going into next year. They're taking what they would have done now and stretching it out. But where you have landlords who may invest in multiple businesses, they can't absorb all the hit. So some people are not being as flexible and saying, I'm sorry, I've got obligations and you're going to have to pay according to the lease, because until you get a modification, you are bound by the terms of the lease as written. To Janice's point on force majeure clauses, You probably would know 4 months in. Again, if you do qualify, the force majeure is going to have to be written in a way that does include acts of God, specifically to illness, pandemic. There are some of these things, and a force majeure clause does have to specifically mention a category that you could find yourself under for rent reduction. There usually is also a category that talks about state involvement. So if the state has forced you to close, perhaps you can look at that. But there's also a question of whether you're still able to operate online or in other avenues, so that just the physical closure of your location does not mean that your business has shut down.
Got it. Just who's actually the judge of whether God has interfered or not?
That would be the judge. And so you can see that if you run into a dispute now, you are much better off trying to reach a resolution with your landlord, because the cost of having to go to court, the court will charge 12% interest from the date of the breach. If you were ultimately found responsible, if you withheld rent unfairly, you could have your lease terminated. You could be kicked out of your space. That might not be a bad thing for some people, but even being kicked out of your space does not automatically reduce your obligation to have to pay for the balance of the lease. So
Right.
It's expensive to throw that all in the court unless you've got some really good force majeure language. And I find that more people are working it out rather than trying to resort to the courts to figure it out.
Got it. So before we go on to the next topic, Leo, I don't know if you or Chris wanted to add anything to that, or you want me to go on to the next one?
No, I think they've covered it very well.
Sounds good. So one of the, I think as we talked earlier with PPP funding, that was a nice injection of cash into a lot of businesses. And yet, I think as people look into the coming business quarters, cash flow and cash is king becomes much more critical, even though it might not be a crisis right now. So what are the best practices in preparing yourself for those kind of projections? And I think if you could speak to not only larger firms where there's a CFO running this, but really the smaller firms, maybe where there aren't those same kind of financial resources, staff in place. What are the best practices? Janice, can we start with you?
Yes, I'll just talk in generalities. I think that Leo is going to get a little bit more specific, but I can't stress enough that hope is not a strategy, right? We don't know when, we can't just hope that this is going to get better. You really need to look at your numbers. So start by doing some pro formas and look at different scenarios. What happens in the case of this amount of revenue? How do I adjust my expenses? And really do a deep dive and do a middle, best case, middle, and worst case scenario. And for budgeting, you're typically going out for a year. And I know that Leah will talk a little bit more about like the 13-week cash flow, which is standard. And but really take a hard look at the cash flow. The difficulty here for our clients is that there's still so many unknowns. They don't know when revenue is going to come back. So for example, I have a client that does school books, even online school books. They have no idea what their business is going to look like. And most of it would have already been in for the fall by now. And there's just so much uncertainty. So there's just a lot of scenarios that you have to keep track of, but just don't hope that things get better. Just don't wait for cash flow to be so tight that you have to make drastic decisions. Really start looking at various scenarios and looking at it so that you can make decisions, about staffing, that you can make decisions about perhaps your own accounts payable or your own purchasing habits. You really need to make some very difficult decisions during this time, but you should be doing it based on looking at your projections.
Got it. And I know, Leo, you've also got some advice that you're giving to clients in this space, and maybe some of it kind of relates to that, be clear and open with your banker, because I'd love to hear from Chris maybe after you as to sort of what he wants to see. But what are you telling clients around sort of cash flow projections and modeling?
Well, to expand on what Janice said, she's right on target. It's really about trying to look at the whole model as a whole, looking at the next 12 months and understanding what's really going on, and see if your business model can actually cash flow over the long haul. But then there's a short-term look at some of these things, and And the tool, as again, as Janice mentioned, was a 13-week cash flow. And this is a common tool. It's been around forever. And we try to use this and make it easy to use. We have an Excel version that is very easy to use. But the real issue here is being able to map out a plan. And as Janice said, hope is not a plan. It's about seeing the math every single week and understanding where the stress points are. Sometimes those stress points are temporary and sometimes they're not. And this is, and again, it goes to the whole idea of transparency. When you work with your banker, you need to show them, I'm stuck for this 3-week period of time. This is where my stress point is, but after that, things get better. And you can actually show them the 13-week cash flow, and they're very familiar with it. And they understand it, and it helps them understand, okay, here's what I can do to help you out. So it really becomes a playbook with your banker that you can use to establish that. The other things you can do that, you're establishing payment plans sometimes with your vendors. You're behind on your vendors. And again, to what Janice said, hope is not a strategy. You can't respond to everybody and give them, your vendors, the money as soon as they scream. You've got to be able to make a commitment and be able to stick to that plan. And if you can't stick to the plan, you need to be proactive in contacting those vendors and revising the plan. And probably one of the more important things when you're thinking about vendors, vendors are usually unsecured creditors. And if there's a bank involved, they're in first place. And the bank will come first. And vendors know this, and they are usually more than willing to work with you given the situation. So I think being proactive in setting up a plan and the 13-week cash flow is what we use as a key tool because it is so easy to use and it spells out everything and it takes the stress away.
Sounds good. So really you're recommending the same level of transparency with vendors, not quite the same level, but similar to bankers. Chris, just before we go on to that topic, anything else to add? Are you having more clients come to you with cash flow projections? Are you requesting or seeing more of that candor?
We are, the first kind of deferral requests, we kind of just took it based on where we are, 3 months ago with the economy and the pandemic. The second request that they're coming forth now, because a lot of these, the first 90 days are coming up now in July and August, we're saying, okay, you need another 90 days, or some of them are asking for 6 months on top of the 90 right now. Because again, to Janice's point, we don't know what lies ahead. We have some caterers and, we have some hotels that, rely on banquets. Who knows when they're going to be allowed to do that again. So, we're telling them to go back to their CPAs or deal with, the folks over at Delta, financial consultants, and lay out a 13-week plan for us. It's very important.
Got it. So we're talking about increasing cash flow, and sort of the two sides of that ledger are who am I paying my money to, right? And what's that pace? And then the other part that we kind of talked about, who owes me money? I know, Jessica, you had some comments on sort of, how to proceed. Are you worried about a business potentially slipping into bankruptcy protection? And what are some of the best practices around collections?
Sure. Well, and best practices haven't changed just because of where we are. Everything that had been the best way to handle collections still remains the best way to handle it. First thing I always recommend is that you're constantly sending out statements so people are aware of what they owe. If you have finance charges, if you have interest that you haven't added, make sure you're adding that so that your negotiating point is as high as possible. Send a demand letter when you get to the point that people aren't responding and you need that cash to come in. And it's not uncommon to see a demand letter go out now more in the 30 to 60 day, if you've got net 30, rather than people waiting and coming to me more at 90 days to ask for a demand. So don't be shy in getting demand letters sent out, letting people know that you're serious and that you need to collect the money. The other best practices for collection would be then to evaluate where you're at. I do think that companies need to set a threshold of where they want to file suit. Filing suit on a case between $10,000 and $15,000 sometimes cannot be cost effective because it costs just as much to try a case for $50,000 as it does for $15,000. So thinking about what you're spending is important. Whether you can recover your attorney's fees for going through collections will actually depend on what your contract says. Be a good time as you have some downtime to figure out if you don't have that if you don't have an interest rate in your documents, that you're thinking about putting those things in place now to protect you in the future. If you find that you're making missteps now, it's a good reminder, keep an idea of what those missteps are and see how you can correct those so your business practices in general are better going forward. But the other option is if you're not getting satisfaction, the courts are open. The courts are open again for things like real estate attachments, where you can attach somebody's land in order to satisfy a debt that you may have. It's open for bank account attachments. There is an opportunity to file a motion without notice to the other side, go in before a judge and ask them to attach a bank account for an undisputed debt. I do think that the courts, the judges are human. It is a difficult time for everybody. And so the judges are going to want to see that there's a real risk that this money is going to disappear, or that companies are going to be closing without getting this recovery, and that the debts are undisputed before they're going to give you a bank account attachment without notice to the other side. I think the judges are doing a good job of really scrutinizing these requests. More likely than not, the court will schedule a hearing with notice, even if it's a short notice period. But these are options that are all available. So if you're not getting relief, you may need to go to court, because sometimes filing the complaint tells somebody you're serious. Attaching money up front certainly increases your leverage. And then all these things are really aimed at driving a settlement, especially now where a settlement can produce an initial down payment and a string of payments over time, or just get you in cash at a discount, but allows you to get something rather than finding yourself in 2 years of litigation. The biggest concern really is how much are you spending to go to court and get this relief versus what are you recovering.
Got it. That's great. And I know, Janice, you had a couple of other kind of tactical thoughts around getting some cash flow improvement.
Yeah, I think, well, we encourage our clients to look at the benefit of using credit cards to receive payment, looking at the service fees to see if that makes sense. I think that we're seeing more companies trying to get a deposit up front. It's a very different world, and you just can't rely on the same cash flow timing that you used to be able to rely on. And yet there's oftentimes, because of relationships and compliance, that you can't delay the payments going out. So it's really critical to try to evaluate your payments coming in to see if there's any way to accelerate it by prepaying, having prepayments come in, accepting credit cards, anything really creative. And on the outside too, I think that you have to just keep in mind that other people are going to ask that of you. And we've also had quite a few people ask our clients that. So it's really hard because it's a push me, pull me. People don't want to do it because they're also concerned about getting their own outflow balanced, but it's worth a strategy, particularly with the credit card use.
Got it. And you know, it seems like everything running through our conversation is open conversations, getting some money flowing, and really just open lines of communication with people on both ends of that.
Yeah, and I think that's what makes this different, Peter, than anything that we've all faced in the past, when maybe we have a client that's in trouble financially, or, you know, there's some sort of isolated incident that you're always concerned about what to disclose and what not to disclose. Everyone knows we're in the middle of this pandemic, and everybody knows we're struggling. So I think from a human side, people are trying to do the best they can through their businesses, but it's just very unlike other situations that we've worked in the past when we've had clients who have had cash flow difficulties, when you're always unsure about how transparent to be.
Right. Got it. Hey, question, we keep going through sources of cash, and someone had asked about an asset-based lender, sort of the pros and cons. And I know, Leo, you had a couple of thoughts about sort of that as one more source of kind of cash, and how should people evaluate? What are those firms, and how does someone evaluate them?
Okay, for the definition really of asset-based lending is really about tying the loan to the asset itself. And the thing that everyone thinks of in the asset-based lending world is the idea of a line of credit. Simply put, a line of credit may be open for $2 million, but it's not open fully for $2 million. It will be the lower of $2 million or 80% of the receivables and 50% of the inventory. So what you really find is that the line of credit is a variable amount that's open to you at any one point in time, and that will change seasonality. The benefits of a loan like this is it can scale up a lot easier, because now the lender knows that the loan amount is tied directly to the asset. They can verify the asset. They can look at the line of credit. They can, the receivables. There's a borrowing base certificate that is usually filed either monthly, weekly, can be as often as daily as well. And it's something that assures the bank that the collateral is always there. And again, the key benefit is a larger line of credit, because it's tied directly to the assets. And overall, this manages the risk. The downside of it is that there are collateral audits, meaning that there will be an auditor that will come out and he'll look at the receivables to verify the receivables, verify the inventory. So that there's an additional cost there. There is also a borrowing base certificate that has to be filed. And you can get yourself caught in some of these trends, particularly in a time like this, where you might be experiencing, as everyone was talking about, slower payments of accounts receivable. It's really built on eligible accounts receivable, which means accounts receivable under 90 days. And there are other things such as concentration of credit risk, cross-aging. These things all reduce your accounts receivable. So if you're getting 80% of your accounts receivable, it's not of the gross. It's after all these reductions. So it works to your benefit in scalability to scale up, but it can also hurt you in times where payments are slow, because customers who have been a great credit risk in the past are struggling right now.
Yeah. So we're within a couple minutes of our targeted end time, and I wanted to get to one question that came in, and then maybe have kind of a summary comment from each of you in terms of just sort of any distilled advice at the very end. The one question that came in was, not surprisingly, Chris, related to our first seminar a couple months ago, which was PPP, and someone was asking for clarification on the form and the timing for them seeking forgiveness, and whether I think they still weren't clear on whether it was that 8-week period or this 24. So maybe you can just kind of reframe people's choices. I know Janice also had some expertise on this. Reframe people's choices as to exactly when and what that form looks like, and how,
Sure. Well, if I had a crystal ball, I'd take it out and take a good look into it and see when the final guidance will be released by the SBA for the forgiveness. Made calls at the state, with the SBA and some of the vendors that we work for, and we're hearing all different days. I think a lot of what the government is struggling with, they built a lot of the processes and procedures, is, initially it came out, it was an 11-page application. And if you're somebody that got, you own a small business and you got a $10,000 or $12,000 PPP loan, you would have had to spend, a few $1,000s working with your financial partner to try to complete the application. So then they came out with the EZ form, which at first glance, it looks like it's going to work. But there's still some further pushback in Congress on that. And there's actually some discussion now that they're looking at potentially drawing the line at $150,000. And basically, they'll put one piece of paper in front of you that you sign that said you use the PPP funds for its intended purposes, kind of an affidavit. You sign it, you send it back, and if your PPP is 150 or less.
So
it's
Chris,
automatically given.
that could be even an easier form than the easy form, correct?
Correct.
And they're still working on that. Wow.
They're still working on that.
Okay.
It's again, this is all hearsay. Different periodicals have it. Contacts that I have are talking about it, but nothing is finalized. I'm sure Janice and Leo, you guys have heard about it as well. Don't know what to tell you when they're going to roll that out.
Janice, is your crystal ball just as foggy on this
It's
topic?
very foggy, and it's really hard for, our clients to be making decisions. And I guess I go back to that the spirit seems to be, particularly with extending to the 24 weeks, to try to get companies to 100% forgiveness. And so we're sort of operating in that environment that whatever's going to happen, we're going to try to get to 100% forgiveness. There's still lots of questions about what happens if your FTEs drop during that period, and a lot of other questions, but we are hoping that we're going to follow the intent, which is to get 100% forgiveness.
Sounds good.
And the borrower can opt to go to the 24-week period, which again, to Janice's point, the government is trying to make it easier and get everybody to that 100% forgiveness.
Got it. So with 1 minute left, any last thoughts you want to leave the audience with? This has been a really terrific conversation.
I'd just like to add that the courts are back open. They are operating again in a new format, but there for people. And know that there are, while people are trying to work together, there are debts that have existed before COVID-19 hit. And some of those people may need to be dealt with in a different way than what we're seeing here. And if you can't resolve this, you do have rights to enforce, and the court is there to enforce them for you. But have an honest conversation with your counsel, because they should be able to advise you on cost benefit and whether that makes sense for you.
Sounds good.
I guess what I'd close with is just, I think we've all said it here, communicate. It's an overused phrase that we're all in it together, but we are. Everybody's in the same spot, and everybody's trying to help. So, pick up the phone, work with your financial advisor, get the information. Banks are willing to work with you. Everybody's willing to work with you. There's programs out there, whether it's the state level, the municipality level, the government level, to get everybody, to a point where we can get back to some semblance of normalcy.
Terrific. Leo?
Chris said it best. It's about transparency and communication, and that works for us. That works the best in these times.
Terrific. Janice, I think that's it's up to you, and then we'll put a wrap on it.
Yeah, no, I just think continue to look at realistically what your inflows and outflows are going to be. Lots of additional expenses with compliance. Compliance costs are not forgivable through the PPP loan. And so it's a large added expense for companies. So really try to pro forma out what your situation will look like.
Sounds good. So just a reminder to everybody, this webcast has been recorded. And if you saw this and said that was brilliant and you want to share that with friends, you can be able to, whether it's family members or you want to see it, or other business associates, it's going to be on the Worcester Business Journal website. We'll send a copy along with maybe some other documents that we've referenced here that might be helpful to the small businesses. Certainly the names and information of our four panelists today. So Chris Watson, Leo Correa, Jessica Murphy, and Janice O'Reilly, thank you so much for being with us here. Thank you to Webster 5 and to Fallon Health, again, for being the presenting sponsors and making this whole series come our way. We thank everyone for joining us today. It was a great conversation, and thank you for bringing your expertise to the table and sharing it with our community.
Thanks
Thank
for
you.
having me.
Good afternoon. Thanks.
Thank you.